Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, October 29th, 2025. It is 10:49 a.m. Eastern Time. So I'm starting this video, and what I'm going to do in this one is go over the staffing sector, so employment. As just about everybody knows, government's still in shutdown mode, which was expected. Obviously, these were probably, at least in my lifetime, not seen such disparity and differing opinions and polarity between the two parties. So, anywho, that continues, and as such, you have a lot of blackout on government data. And what we know today, we have the Fed announcement. This was yesterday. Let me refresh. Yesterday, it had bumped up. Last time I covered this for you, we were at about a 97.3% chance of a 25 basis point rate cut. Yesterday was 99.9. I imagine today will be, let me refresh because that was, it dropped a hair. So a near certainty that the Fed will cut a quarter point. So, all right, everybody knows that. It's been widely telegraphed. This Fed usually doesn't surprise. So as I said, if they happen to, if you're going to play those extremely low Vegas odds, some people will bet those extreme low odds because the payout's very high, and that would be the VIX. I think regardless of what the Fed does, again, if they cut 25, it's about what they say. 25 is priced in. Again, I've covered my thoughts on the VIX and the market quite a bit. I'm going to go over in this video. Let me get to the point. I want to cover the staffing sector and look at that. But I just wanted to talk about this, and then because it's highly related to this, the Fed is cutting, as you know. The Fed's dual mandate is maximum employment and price stability. And on the price stability front, that's talking about cost of goods throughout the country. And inflation is still running at 50% above their target of 2%. We're running at about a 3% annual rate. So normally the Fed wouldn't be cutting rates because that tends to stoke inflation, fuel it. But as we all know, they're cutting for the job market. And that's what Powell will talk about. That's what I want to talk about. This is the unemployment rate. Again, whether you agree with this or not, a lot of people say it's understated. Let's not go there right now. Let's just use this. For the most part, it's going to track the trend. So I'm going to change up the color tool here to red so we can draw some red arrows. Okay, and I've covered this many times in the past. And just for any those new to the site, remember a couple things that I say, and I didn't make this one up. The stock market is not the economy. Let me repeat, the stock market is not the economy. Sometimes, over time, it will track economic trends and corporate earnings and growth, but there are quite a few times where one will go the other way, whether the stock market's in a bull trend or a bear trend, and the economy has long since inflected or turned. And so the problem with that, the stock market's priced in real time based on human emotion, sentiment, beliefs, herd mentality, all those other things. That's why trends can be very powerful and often go long past the point they should. And so, okay, so what I can tell you definitively, we all have our opinions on where the market's going, where the economy is going, but these are the recessions. Of course, these are the recessions as declared by the NBER. They have a subjective measure. The old antiquated definition is a 2 quarters of contracting GDP or negative or contracting GDP growth. And so the last real recession, COVID, but if you blinked, you missed it. Government, were shut down around the world, but then things opened up and there was so much liquidity. Again, unprecedented, so everything exploded after that. That's it. So what I've talked about many times, there's a nearly invariable pattern that shows once employment troughs, and again, depending where you are, this goes back to all the way back to the 40s here on the left of the chart. This starts 1950, and you can see all the recessions in gray. And as I talked about, there's a clear trend of employment falling to, there's a level around this area, call it 3%ish, is pretty much where unemployment will trough. So in a strong economy, you're never going to have 100% of the people working, and that's it. That's the bottom. So a couple things happens when it troughs. it usually doesn't stay there. It inverts, and it inverts in almost a V fashion. And you can see the inversion. Once the inversion takes place, the turn happens, the recession invariably follows. So these gray areas, these are the trough in employment, and the gray areas, so employment peaks, troughs first, unemployment troughs first, or employment peaks, you could say it that way, and then the recession follows. And again, it's there's not a lot of variability to this pattern, but yet I say this because it's the same folly over time and time again. These cycles are generations right here, and we're going back many, many decades, and that's it. So that's the way it works. And the $1 million question is, where is that bottom? But again, it's in a range, and we know that it's like stretching a rubber band. You get to the end, it's only going to stretch so much more. Let's just say it's a rubber band that can't break, right? And that's it. So here we are. We've already clearly inflected. This is unusual that the stock market, that the recession hasn't been declared yet. And now things are again all wonky with the government shutdown and data blackout. So what we're going to do, and the whole point of me starting here is to segue into let's try to get a feel for what the economy is doing. I've been following the headlines, and I'm sorry I don't have them all in front of me. I know the latest was Amazon. I think 10,000 job cuts they just announced. There were a couple other good-sized companies out there that I've seen in the headlines recently that just announced job cuts as well. But all right, let's go to this sector, and again, we're going to compare. This is staffing and outsourcing services. So with a blackout on the jobs numbers, of course, we still get the ADP employment reports, and we're going to look at that. ADP is in here. So these are your companies like, you can see over here as I move this screen over, these are all the components of that sector. ADP, which most of you know, probably the biggest payroll processor in the country, if not the world. I'm guarantee a lot of you listen to my voice, either currently or in the past have had your paychecks coming from your company and being processed by ADP, or Paychecks. They're another really big one. And then we'll go down the line here. There's quite a few. Those are the big ones, and we're going to see if we can extract any useful information. That's the point of this video. So I'm going to tell you right now, if you want to save your time, that this is not full of actionable trade ideas like most of my videos. I try to convey, just be efficient, get out. I'll ramble on with my fundamental thoughts when I have them, but most of the time I'm covering charts, technicals, and showing you things that look to be setting up for either a long side trade, a bullish opportunity, or a short side trade, a bearish opportunity. And there might be some takeaways in here. I'm going to go through these charts. But most importantly, you can see here, let me change my arrow color to show better on this chart. The white line that I have here is the VTI. VTI is the Vanguard Total Stock Market Index ETF. It's the closest thing there is for an ETF, or it tracks an index. The closest thing it is to the true measure of the U.S. stock market, because as I've covered in the past, VTI, it seeks to track the investment performance of the entire U.S. stock market, approximately 100% of the U.S. stock market, including large, mid, small, micro cap stocks. All right, so remember, the S&P 500 is great. It's better than the NASDAQ 100 for looking at the stock market, but it is only the 500 largest companies in the U.S., and there's thousands of publicly traded companies. So you're missing the whole small cap, mid cap universe, and so that's why I'm using on the comparison here. Let's go back to that. Let's go back to the staffing. ADP what was that sector? Here it is. It's in TC 2000, and I believe they still have. I think they still offer freestockcharts.com. Just a free version with maybe banner ads. Again, I don't know. I've been using TC 2000 for a long time. IX 2130 is the code for that sector, and you can see it tracks. The VTI goes back to 2001. Here, I could put the S&P, but what you want to see is I can show you how clearly it mirrors the stock market, right? As it should. So again, look at the direction they're both heading, at the same time. Look for the major inflection points, major tops and bottoms. Hopefully you can see that. This is where they both troughed right there. They both peaked. But what happens is usually this sector will peak early. It's a canary in the coal mine. For those of you not familiar, consumer spending accounts for about 70% of GDP. So the government can inflate and spend away all they want and stimulate with, government stimulus in bloated projects to try to stimulate the economy, but they can't not offset a drop in consumer spending. It's by far the largest component or contributor to our GDP and ultimately profits in the stock market. So there it is. You can see the very, very strong correlation. Again, you're not going to see the lines overlap. They're not the same thing. They're not priced in the same units. You just want to look, when are they going up, and then they correct together, a little correction there, and then they peak around the same time and they trough around the same time. That's a correlation. So what you're seeing now is unprecedented. We saw a little drift a couple of years back. I mentioned here we were peaking, we were coming down, and the stock market was holding up at the previous highs. But that was nothing like it there. The staffing sector peaked a little before the market, and then it was the S&P that peaked right here in the beginning of 2022. The NASDAQ actually peaked around that same time. So that was kind of a heads up when the S&P 500 was making new highs, as was VTI on a daily. This line chart won't show the candlesticks that spiked high. It just shows weekly closes right now. And that's it. So I just want to point this out, guys. I think you can see where I'm going. This disparity is pretty much unprecedented. And it's, I just, again, what does it mean? My takeaway is that the government data is being incorrectly reported. Even before the government shutdown, it was widely known that the government in recent years, funding has cut back at the federal level, especially with this new administration. And they've been using more and more imputed data, which is a fancy word for guessing. When they don't have all the information they used to. All I can tell you is this is real. And if you're trying to look for a canary in the coal mine and figure out, okay, is the economy really on solid footing? And so, again, what I just showed you, started the video with, is that the turn has happened. And historically, once it's clear and it's not, let me just toggle back to that. And again, I just want to make sure my interpretation of this is very clear, is that these little things here, let me make it red again. These little blips, if you will, are just squiggles. They're just, you're going to have month to month some variance. So you can clearly tell when you get a little uptick, is that just an uptick in the current trend, or is there an inflection point? So once you get enough of those, it's very clear, again, that a turn is in. And it is not impossible to see this. It would be very improbable to see that. Again, look at where unemployment, especially in recent years, has troughed at the same exact level. Again, things are a lot different, I think we can all agree, than in 1950 when your wife had an apron on and stayed at home and met you at the door with a brandy and a cigar, versus today, right? With both spouses working, a whole different thing. So, again, where things bottomed back in the 50s and 60s isn't as relevant to me as where they bottom in this modern era that we're in now. So, and again, the inflection, I don't have to squint or take any liberties to say, yeah, has it turned? And again, my point is, you've always seen the Fed starts to cut. And that's the other. Here, let me do that for you. And again, guys, I'm talking fundamentals now. I'm using charts, but to talk about fundamentals. And same story is when the Fed starts, after a rate hiking cycle, they start to cut, not because they want to juice the stock market, especially at all-time highs. They cut because the ship has started to turn. And pretty much they see the inevitable coming, what I just showed you. In the job market, there's just powerful forces that create trends. And once that trend changes, it's nearly immutable. It's nearly impossible to change, and they will cut rates, and that's what they've announced. But yet the market's rallying on that like that's somehow bullish. When history shows you when they start cutting rates after a rate hiking cycle, that's when, look at the gray areas, that's when the recessions follow, right? Rates peak, level out, they start cutting, rates peak, level out, they start cutting, rates peak, level out, they start cutting, rates peak, they start cutting. Again, now what happens is the masses don't know this. There's a lot more, for lack of a better word, let's just say uninformed, people out there that are, they're plumbers and they're pilots and they're doctors and lawyers and Walmart employees and all that, and they have money in a 401k. They don't know this stuff, so they're buying, and that's what's driving the market up because there's a lot more of them. And if they're pumping money in there, most of them with these automatic 401k payments, 401k plan contributions, money's just flowing into the market, and it'll continue to flow until that trend changes. So that's it. I just wanted to point these charts out. They're pretty powerful, and again, so the market, smart folks know this. But again, they don't care. If you run a mutual fund or a hedge fund or a pension fund or, your Schwab 401k money's coming in. And if, the masses are still pumping money into their stock funds and still buying stocks, that's just an opportunity. So my point is, I've been talking about this now for a while because this has long since started to happen. The employment market has long since troughed. I've showed that chart now for several months, showed this one for several months, and it will ultimately play out. And the thing is that I'm trying to impress here is that the ensuing reversal, just like we saw that crowded rush for the exits in silver that I warned about, but I waited, boom, there came our sell signal. So yes, we just had some sell signals in the stock market. We're still below the primary trend lines there, right around there on QQQ, give or take. And this week, like I said, it's going to make or break it. And, the charts are lined up, and it can happen very fast. We cannot eliminate the possibility of a blow-off top. Most certainly can't eliminate that. But like I said, I'm sitting tight this week. I think the VIX and shorts on especially the high beta indexes, QQQ, even SPY at this point in time. I think the risk reward is favorable because I think the odds and risk of a blow off top, especially one that exceeds maybe 10% very short order, is overshadowed by the risk of a very sudden and swift drop. A lot of the ingredients are there right now, including sentiment, low short interest, put to call ratio extremes, things like that. So let's get back to the sector here. So again, I just wanted to point out that very, very stark and I believe it's safe to say unprecedented divergence between, again, the blue line here is VTI, the stock market. If I put SPY, you'd see the same thing. The white line. I'm using the blue arrows. This is where they both peaked, and then this is what's happened in that sector. So now let's just go through a few of these individual names, because as I like to say, an index or a sector is simply a sum of its parts. So I'm going to turn that line off. This is ADP, by far the big one. ADP's been around forever, so we can go back as long as we want. Being that I don't have, let me put up SPY here because the only problem with the VTI is an ETF. It doesn't go back that far. So we're going to put it on SPX instead. Let's just change that to the S&P 500 so we can go back a little farther to that last because we did have a bear market back in 2000. The recession wasn't that bad. It was, why didn't it take SPX? Oh, it wants me to click on it. SPX, there it is. Okay. Alrighty. So now you can see. I believe you can see. And so what I can tell you, if you can't, I'm going to have to get in here real tight. This is where the stock market peaked back then in 2000. And this is where ADP peaked. ADP went a little higher. Remember the stock market, we had the dot-com bubble back then, but you can see how well they tracked. And throughout history, look at this. The line is just right on there. Again, you're going to have VTI and SPX are going to look almost identical because they're pretty much the stock market, with SPX just being large caps. But there it is. There's that divergence. And you can see here, again, this is pretty much unprecedented. And if you remember we shorted that bear market with impunity. We were in at the highs from sell signals, covering at the lows on the 2022 bear market. And what happened there is both ADP and the market peaked around the same time. We're trending, but then this was saying, hey, guess what? It's clear here that ADP went on to new highs while the stock market bottomed. And that was saying, hey, guess what? The job market still has some legs to it. Look, ADP's business model is simple. Same with paychecks. They're processing payroll, so it only makes sense if the country loses a million jobs and ADP has, I don't know, you can look it up, but let's say they have a 60-70% market share on payroll processing. They've just lost $700,000 jobs, and so they're getting paid on scale here, and it's a very simple business model. The job market drops and a lot of people are unemployed. They're processing a lot fewer paychecks, so they're making less money. And so what's going on here? This is unusual. Again, we were tracking in lockstep. This stock was tracking in near lockstep until right about here when ADP peaked. And it's been heading consistently lower. I'm going to get to the daily charts in a second. I'm going to just show you more. So we're going to look at a few more. Why did I do this? Why don't I just stop at ADP since they're the big dog? Because any one company can have some unique company-specific situations that may be impacting their earnings or profitability, despite the sector as a whole not having any problems, right? So that is, once in a while, you can be a chip stock, and all the other chip stocks, or a gold mining stock, and all the other gold miners are going up, but you're going down because you have certain specific company problems, that the market sees. So that's why we're looking at paycheck, and you can see the same exact perfect mirroring, relatively perfect mirroring, with each of these turning and moving up and down with the market. And again, I don't know if this is being talked about anywhere else, but to me it's glaring, and it just shows to me the opportunity when this sucker turns. Okay, where I'm going again, for those of you that said, yeah, Randy, you've been talking about this big drop coming for a long time. When it turns, it helps me gauge the magnitude, because how wrong the masses and the so-called smart people, the pundits, the folks who come on CNBC and all that, and they're supposedly managing money and telling you everything is hunky-dory. This doesn't really confirm that. And again, like I said, of all things, if you could only watch one thing, credit markets are important. But the job market, again, being the consumer spending is 2/3 of GDP. And so, again, there's a whole nother, I'll get to the credit markets. Again, I want to do an update on BIZD. Read a great article in the Journal last night, an opinion piece about it. And I'm thinking about just booking profits, closing that trade out officially. I told you I took profits at T1, and I may close that trade out officially for, and let you guys, if you want to keep on it, great. But I think the next shoe to drop is coming in the private credit markets. So there's it. I can keep going through here, but what happens when I do this is I'm clicking my watch list. More and more of these companies only came public, this one back in 2021, so you don't have the history. But what you can note as I'm going through this, a lot of these companies peaked back then in 2021, 2022. This one might even be Chinese, Canzun Limited. I've never heard of it. BZ is the ticker. It's in the side. I'm just going in order of market cap, as I often do. This one's been around for a long time. Korn Ferry International. There's your peak right there. And the S&P peaked a little. This one peaked first. That's another common theme. A lot of these will peak first. This is the S&P or the market, the Nasdaq. The bubble popped in March of 2000. It was about concurrent, close to concurrent, and you can see how well it tracked. This one, the stock actually peaked back here in 2021. Put in a lower high. Again, another recent lower high with the stock market going to new highs. So there's one we can go back that far. TENT, Trinet Group, we can only go back to 2014. But again, so when I can't go back to look at the past track record, just look at where these guys are going. And again, I do this because if I look at just ADP, I'm looking at one, I might get a false signal. So I like to look at the whole sector. As I say, an index or a sector is simply a sum of its parts. And that's it. And so that one's telling you, despite, what Wall Street or a lot of economists are saying, how, hey, we're still on solid footing, job market's softening a little bit. This is more than softening. This stock is down, and with zero evidence of a reversal, down 56% since it peaked in the beginning of 2024. Here's Robert Half. This is a big company. And again, look at it. It's done a good job of tracking, again, because it's simple. The stock market isn't necessarily economy, but it roughly tracks the economy and corporate earnings, right? And so this is going up with the stock market. And, they both corrected here. Then what happens? The stock market said, oh, I'm going to new highs. AI is everything. And AI stocks did this. We know that. It's not my opinion. I forget the stats I see coming out all the time, but it's like the top 4 or 5 companies in the S&P 500 and NASDAQ 100 account for over 50% of the returns. It's just insane. And so this is what's going on with this one. Robert Half got halved right here. It was down 50%. So it's more like Robert, it's down 80, 78, 79, almost 80%. So it's more like Robert 3/4 now. And again, something is rotten in the state of Denmark here with this stock, especially peaking back here. And that's it. So I go through these one by one. I look at a lot of them peaked back in 2021 and are way below there. Nothing but a bear market rally so far. This little zigzag up, it's still way down from its peak. NSP, Insperity, we can go back. This one will go back a while. This one's been around a long time. A lot of price history here. And you can see how, again, the trends pretty much ebb and flow with the stock market. But what happened? This company peaked right here back in 2019. Came close to that high, but plateaued out in 2021 and again in 2023. You can see my year breaks down here. And so what is going on with this stock? Since the last peak in 2023, this thing's down 66%. Okay, so these are, to me, just based on this logic again, that, if this would imply that the job market is either currently a lot softer than the government data, even maybe ADP is reporting to us, or those in the know. Remember that stocks, the reason technical analysis is so much more accurate, especially in the near term, of predicting where stocks are going to go, is because all known variables are being priced in. And as I often say, insider trading, although it's still, fairly prevalent, illegal insider trading, that's what most of us think. There's insider trading, or at least trading from insiders, which is legal. And those that are in the know and in this industry, they're certainly not buying their stock. Somebody's certainly selling their stock. So that's it. Manpower, another one. This one's been around forever. I'm rolling back. This is as far back as I can go on the weekly chart, by the way, guys. So that's why I'm going back here. We're in the 90s, and you can see this stock goes up when the stock market's going up. This stock goes down when the stock market's going down, because the stock market, again, over time, is going to reflect economic conditions. So there are, again, the disparities, and those are opportunities. And that's it. So here goes the stock market. This stock peaked back in 2017, but effectively put in about an equal high back in 2021, like so many. So this tells me if you take these collectively, and again, I'm going through enough names that it's not a one-off situation with one company that might have their own unique problems. This is screaming that the job market's in, whether it's currently, if you can screenshot it at this moment, or where the insiders in this industry or the smart money thinks it's going. This thing's falling off a cliff here, guys. A lot of these stocks are not just and the ones that are held up, they're relatively holding up, have quite bearish charts in my opinion. This stock's down 74% since this 2021 peak, and a total of about 77% since that all-time high back there. And you know what you guys can do, if you're interested in this is kind of fundamental. You can look into each one. I don't know all of these companies, what their specific business model is within the staffing and outsourcing industry, but you can kind of see, and this one's kind of gone now anyways. There's no point. When you see these gap up and these little candles, that's typically a buyout, and they're either being taken private or being acquired by somebody else. So that one, don't waste your time on that one. BBSI, this one goes back quite a ways. Barrett Business Services, and you can see again, I have to zoom in to the most recent price action. This stock has dropped, it's almost all red sticks, down 17% since this peak right here a couple months ago. And you can also see, I believe you can see below, remember the white is S&P. These blue and red lines, those are the 200-day/40 week on a weekly chart. You want 40 period moving averages, and this stock was above it, just recently took it out. And again, going in the complete opposite direction of the stock market. It was holding up until recently, and that's the common theme. That one's gone. When you see a chart like that, went away. KFRC, kforce.com. I'm not familiar with them, but you can see how they've tracked, and you can see what's going on here. Clear peak right here, lower peak right here, and then it just started, it's been falling off a cliff since then. So down 65% with the stock market ripping to new highs like everything's hunky-dory. I'll rifle through the rest faster just to see, because these are some common names. You probably heard of ZipRecruiter. ZipRecruiter peaked in 2021, shortly after they came public, and it's just, the stocks, like some of these look like they're headed to bankruptcyville. I mean, their charts look like death. And again, it's just indicative. This is Kelly Services. Look at these, look at the charts, look at the comparisons. Remember, your year breaks are down here at the bottom. So this one peaked in 2018, been making lower highs, and lately it's just really coming down hard. So it shows me that this is indicative the job market is rolling over at a much more accelerating and concerning rate than is being reflected in the official numbers. Even which, again, since the government's blacked out, the market's been kind of queuing off ADP's numbers, and I already started with ADP stock. Let's do that. So I'm going to bore you if I go through. There's only about another dozen or so, but let's just look at the daily charts on a few of these, and we'll wrap it up here. So here's ADP. I know this is a busy chart. Forgive all my levels here. I usually have a cleaner chart. It says board 8 clean, even tells me go to board 8. But here, I'll do that. Let's see, board 8 clean. There it is. All right, this is a cleaner chart. You don't see as many horizontal support levels and all that. There's a clean primary uptrend line. 1, 2, 3, 4, 5 clean distinct reactions, a breakdown, and a back test below it. Right there. That is a 100% textbook, my kind of sell signal. I've been covering this one quite a bit. Also, has clearly taken out the 200. So what do I mean by that? Well, every now and then these stocks will tend to punch through their 200s, little fake out moves, and as long as they can recover the 200s, your uptrend's intact, right? And these are just little washout moves. And I always say, get to know your security. Look at the history of it. Does it have a history of punching through there and then snapping back above? If so, you might not want to load the boat short on the first break of the 200s. But in this case, you took out both the 200s and the primary uptrend line, which is a much higher probability sell signal. You back tested for, this is a daily chart, so we had couple weeks of back testing, and then rejected. And then once we took out this area of back testing, this little trading range, that was it. And so boom, I guess they reported. Market's not reflecting this today. It couldn't have said anything good to be down 4.5%, I have to imagine. And again, the technical said this is where they would go, right? Here's my next target, 256. I believe I've shared this one as a trade idea for you, and it's coming off these divergent highs. Paychecks. This is Paychecks here. So Paychecks, you have a similar story. Again, it's a busy board, but off the 2020 lows, nice, clean, well-defined uptrend line. 200-day moving averages also recently taken out with that trend line, just like ADP. Again, clearly in a downtrend. You're going to get bear market rallies and bounces in these guys. Again, these guys are coming off their highs. You can't, from a technical perspective, you can't write them off yet. There's really big support down here on Paychecks right there around 105.79. And once that goes, I believe once that level goes, it'll be clear to all what I'm seeing in these charts that the job market has turned to the inflected to the point of no return, and that all the Fed cuts in the world aren't going to do anything. Again, that's the pattern. They start cutting, then the recession comes, the cuts will follow, and but you've turned a giant tanker ship like in the ocean, and once that turn's completed, it doesn't just whip back around. It's the trend has changed. There's BZ. That's that Kanzon, probably Chinese company. Again, I don't know. I'm not familiar with them. Bearish rising wedge. Look like a bear market rally. KFY, Corn Ferry. Again, I just showed you these guys on a weekly chart, and on this daily chart, you can see kind of divergent high, correction, divergent low. And that was an equal divergent low right there. I should have brought that line over and just extended the divergence. It's just like the market. Sometimes you put in a divergent high or any other thing, and then you make a marginal new but still divergent low, then the turn comes. And then you can see right here, at the same time it broke out of that bullish falling wedge, it took out those, you got it, the 200-day moving averages. Boom, 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 bull market. Boom, boom, boom. What? Divergent high. Uh-oh. Trend line break. Rut-row. 200-day break. And below them, below them, below them. Right now, it got back above them. It's been whippy. I'll give it that. But we once again came full circle with another divergent high. Trend line right there. Bearish rising wedge. Breakdown, and it's right on the 200s right now, plus price support. So this one, take it as a trade idea. The support's around $69 with the next support just below it. You might want to, give it the benefit of the doubt. That's 66, 70-ish right there. If it takes that out, it will have lost the 200s again. It's going to come down here to 59.90. That's going to be a drop of, if you want to short this one, for example, of about 10%. TNET, Trinet Group, bullish falling wedge, but in a bear market, you're going to get those. Its stock peaked back here. It's down, 57%. I wouldn't short this one now, but that doesn't mean it's going to go up just because it has divergence. Here's your, until it takes out the 200-day moving averages and this downtrend line, trend's bearish. So you're going to get bear market rallies back to the 200s and that trend line. And you just want to short them or wait till they break out and then go long, especially if it aligns with your views on the economy and the job market. RHI, Robert half, as I said now, Robert 3/4, really. It's down over 80% or close to 80%, over 3/4 off its high. Upwork, UP, WK, better looking chart. Again, if this economy can pull a rabbit out of its hat, or the Fed can, and somehow turn the job market around. But other than that, again, you look at the weekly charts, it paints a bigger picture on most of these. This one doesn't have a lot of price history, so I'll go back to the daily chart. All right, I'm going to wrap it up here. I went over the charts, most of them on the weekly time frame. There was your divergent high. There was your, I wasn't following this one at the time, so I'm just marking it up now. And yeah, it's, it has divergence, but that's the thing about a bear market, as I often said, I've often said recently, the road to a bull market top is paved with negative divergences, meaning you get those divergences, you get corrections. Usually you don't play out for anything more than just that. and then ultimately one of those divergent highs play out. Same thing in a bear market. Once you top, I could probably go in here and draw several divergent lows that just played out for brief pops. Right there was one, the first one, and it was a bear market rally. You're below the 200, so that's all it was good for. You had another divergent low right here. I'm just drawing them out for you. And you got another rally. And look, this is what I do. In bull markets, I'll short pullbacks. And in bear markets, I'll trade these bear market rallies. I'll take them all day long. That was a 24% rally back to the 200s. That would have been a logical target, right? And you had the divergence there. I'm sure your buy signal would have probably come on a breakout of a 60-minute downtrend line. There was another divergent low. All right, so you get the point. So I'm pointing out, yeah, you're going to rally again. So if I do this video, I get it out to you today. And next week, a lot of these stocks, that are way oversold and with positive divergence, maybe they pop. And at most, you're going to get, again, if things change, if I'm wrong on that, and you get more than a rally back to the 200s or whatever. Some of these have nice, clean downtrend lines as well. We don't on this one. I'm just using an example. But, if 2, 3, 4, 6 months goes by and I see more and more of these stocks breaking above their 200s, breaking above their downtrend lines, like Paychex, for example. Paychex has this downtrend line. And there's another example. You got to be careful in bear market rallies. You get a lot of false breakdowns. These were just intra-period whipsaws. And we also had price resistance right there. That was one of my targets on the way down, 128.82. So we hit this target here, this support level. They reported earnings. They had a bear market rally. If you happened to buy the low that day and you swung it up, you made 8% in a day. But all it was so far, and this is the nature of a bear market rally, violent rejections after it's over. So just like I like to trade corrections and things in a bull market, and I like to trade these bear market rallies, counter trend trading, you have to be Johnny on the spot. You can get in early, scale in early, build a position, but your exit points have to be spot on. If you stay too late to the party, April 6th or 7th was a great example of that. If you were just waited in the stock market, remember the Nasdaq had its best day, and we were long for every penny of it. Right there, that green candle. This was the single best day in I forget how many years. We went from, I think we closed right here, and one day it was a 12-something% gain in a day. And we were long. We milked that thing up to our price targets and exited there and pulled back and reverse and gained that little bounce and then went long again. So the point is, if you stayed just 2 days too late to that short position, this is when liquidation day, Trump's stepped up the podium cane, and you would have been very excited if you got in. And I gave you a meltdown point where I said the markets would let loose, collapse, bottom would fall out, and that happened that day and after hours when he stepped up the podium. And so we were already short from the move down, but then that all in, and we had a 15% drop in a couple of days. So you would have been high-fiving yourself, especially if you were long the VIX, short the NASDAQ. But again, if you waited just 2 days to second guess or act on it, you would have given back all those profits. And that's my point. And so you gotta have a trading plan, guys. You gotta have a trading plan. I'm not always gonna be right on my calls. Some will be right, some won't be. That's just part of the game. But whatever it is you're trading, whether it's gold, silver, Bitcoin, individual stocks, bonds, the market, recognize when you're in trading with the trend and you're buying pullbacks to support or breakouts. When you're trading with the trend, your timing doesn't have to be as good, especially as an investor. You could be buying at the worst points on a strong bull trend or shorting at the worst points in a bear trend. But counter trend trading, guys, you got to be very, very nimble, if you will. All right, I'm going to stop it here. There's, like I said, my plan. Sit tight through tomorrow. I'll be leaving tomorrow afternoon, probably after lunchtime. I'll be leaving town out away from my desk on Friday and Thursday afternoon. And again, as far as core positions, core shorts, VIX longs, I'm still at that, plenty of room to add. I'm going to go in, short the markets, long the VIX into earnings because I think that's the way the chart's going to go. I'll probably do another video before I leave to show you the big Mag 8, 9, 10, whatever you want to call them stocks, their technical postures. Again, I think that's where the risk reward is favorable, but not an all in. You go all in aggressively long or short, tech heavy, things that are tracking the NASDAQ or the major indexes, you're either going to be very happy or very sad by the end of this week or into next week. That's my thought. I doubt when I've seen markets like this, and when you have this kind of melt up move right here after a prolonged uptrend, rarely do you just sit here and trade sideways like this for a while. It's possible, but again, there's a lot in the charts that's saying this thing's going to break one way or the other. All right, let me wrap up here, get the video out to you guys, and then I'll start working on the next one. This has been Randy Finney with Right Side of the Chart. Have a great day.